Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is key takeaways from the CFPB proposal to amend Regulation X mortgage servicing rules. My name is Krista Cooley, and I'm a partner in Mayor Brown's Financial Services Group in our Washington, D.C. office. Joining me today to discuss this proposal are Mayor Brown partners Krista Beaker and Tori Shinohara. Krista and Tori are both partners in our Consumer Financial Services Group in our Washington, D.C. office as well. So the proposed changes to Regulation X's loss mitigation process requirements have been a long-awaited change, and the changes being proposed in this recent proposal that was issued last week by the CFPB are incredibly significant and present a very unique opportunity to help reshape the loss mitigation process. So today, Krista Beaker is going to start us off by summarizing the changes to Regulation X that the CFPB is proposing to make. I will then talk for a few minutes about some of the preliminary questions raised by the proposal, as well as some potential challenges that the proposed changes could create if implemented as currently proposed. Tori is then going to discuss the proposal to implement certain requirements regarding communicating with borrowers in languages other than English. So at this point, I will turn it over to Krista.
Thanks, Krista. So, to give us a little context for the new rules, I'm going to spend a couple of minutes providing some background on the Regulation X servicing rules. The CPB's mortgage servicing rules initially became effective in 2014, so 10 years ago, and the rules introduce a complex network of default servicing requirements. The requirements were designed to address a variety of problems in mortgage servicing that became apparent during the 2008-2009 financial crisis when servicers were not prepared to handle the deluge of borrowers in default that we saw at that time. So during the crisis, we heard reports of servicers failing to answer borrower phone calls, failing to respond to borrower complaints, losing documents borrowers submitted, and requiring borrowers to resubmit the documents, and in some cases, even foreclosing improperly. The 2014 mortgage servicing rules had three main prongs. So, first, early intervention provisions that required servicers to reach out to borrowers soon after they became delinquent to let them know about what options might be available to them. Next, continuity of contact provisions that were designed to prevent servicers from giving borrowers the runaround and required servicers to designate dedicated personnel to respond accurately and timely to requests and questions from borrowers in default. And then finally, loss mitigation provisions that created an organized process by which servicers were required to evaluate borrowers for loss mitigation options. The rules were quite prescriptive and included detailed notice and timing requirements. And the COVID crisis really put those rules to the test. And in many ways, the rules served us well. The systems, policies, and procedures, staff, and infrastructure that servicers put into place to comply with the 2014 rules meant that they were better equipped to handle the COVID crisis than they were the 2008-2009 financial crisis. But in other ways, we saw that the rules were clunky and didn't give servicers the flexibility they needed to get assistance to borrowers quickly and efficiently. So the amendments the Bureau released this month are in part designed to respond to the issues that arose during the COVID crisis. And I'll walk through the main requirements of the proposed rule. So first, the amendments completely revamp the loss mitigation evaluation process. They remove a requirement that servicers collect a complete loss mitigation application before evaluating a borrower for loss mitigation options. So currently, servicers are generally prohibited from evaluating a borrower for loss mitigation options unless they receive a complete loss mitigation application from the borrower. This is known as the anti-evasion provision, and the idea is that borrowers should only have to submit their materials once, and then they can be evaluated for all the options at the same time. The CAPB thinks this is, a more efficient process. And that's a worthy goal, of course, but it trades off with servicers' ability to be nimble and get help to borrowers quickly. Completing an application can be burdensome and require borrowers to hunt down tax information, draft a hardship letter, and things like that. And over the years, the CFPB has added various exceptions to the anti evasion provision that allow servicers to offer certain options, like a forbearance, including the CARES Act forbearance, based on an incomplete application. And streamlined options, options that don't require documents or that require only limited documents, have become increasingly common and, by most accounts are achieving good results for servicers and borrowers. So the proposed rule overhauls the requirement that servicers review loss mitigation applications only once they receive a complete application from the borrower. Now, under the proposed rule, servicers would be able to review borrowers for loss mitigation options one at a time, and they don't need a complete application before they evaluate borrowers for options. The rule also revises the foreclosure protections that apply when a borrower has submitted a loss mitigation application. So currently, the rules prohibit a servicer from filing for foreclosure or moving for foreclosure, sale, or judgment if the borrower has submitted a complete loss mitigation application at least 45 days or more before a foreclosure sale. Under the new rules, a servicer would be prohibited from advancing or initiating foreclosure if the borrower is in what the rule refers to as a loss mitigation review cycle. So, under the proposed rule, this review cycle would begin when the borrower requests loss mitigation assistance, provided that the request is made 37 days or more before a foreclosure sale. And the cycle would end when a servicer implements a loss mitigation solution for the borrower and the borrower's loan is brought current, or when a procedural safeguard is met. And we'll talk through what those procedural safeguards are in a minute. So, because a request for loss mitigation assistance completely halts foreclosure, what exactly counts as a request for loss mitigation assistance is significant. The proposed rule defines requests for loss mitigation assistance broadly to mean any oral or written communication occurring through any, quote, usual or customary channel for mortgage servicing communications, whereby a borrower asks the servicer for mortgage relief. The borrower doesn't need to use any specific form or any specific language to submit this type of request. And the Bureau even goes as far as to say that the servicer should presume that a delinquent borrower has made a request for loss mitigation assistance when they contact the servicer unless they clearly express some other intention. So it's really broad. Although the Bureau has said that certain types of communications don't meet that kind of usual and customary channel standard, such as if you send a request through social media or something like that. But the idea of this loss mitigation request is very broad. The preamble to the rule clarifies that the loss mitigation review cycle would continue when the borrower is in a temporary or trial loss mitigation period, such as a forbearance or a loan mod trial plan, and the loan hasn't been brought current. So, practically, that would mean that if the borrower is in a trial mod, supposed to be making these trial mod payments every month for maybe 3 months, the borrower is still in this review cycle. And if the borrower fails to make those payments and the trial mod is canceled, the borrower is still in that review cycle and remains in that review cycle until the borrower's loan is brought current or until one of these procedural safeguards is met. The Bureau thinks these revisions will limit dual tracking. Dual tracking refers to kind of working with the borrower to find a loss mitigation solution at the same time you're moving forward with foreclosure. And the Bureau says that dual tracking can cause substantial harm to consumers, can result in inconsistent and confusing communications and servicing errors. As an example, we've seen servicers cited for sending a letter to borrowers that says, you have 30 days to complete your loss mitigation application, and then foreclosing on the borrower within that same 30-day window. So that's the type of kind of confusing communications that the Bureau thinks that this rule would limit, because the rule would, uh, you know, shrink the amount of time that a servicer is pursuing both loss mitigation and foreclosure simultaneously. So, under the proposed framework, a borrower is placed into this loss mitigation review cycle if they make a request for assistance. And once the cycle is initiated, the servicer is generally prohibited from advancing or initiating foreclosure unless a safeguard is met. And there are two safeguards. The first is that the borrower has not communicated with the servicer for 90 days, even though the servicer is communicating with the borrower. And the second is the borrower has been reviewed for all available options, none remain, and the borrower has exhausted the appeals process. In addition to foreclosure protections, the CFPB proposes to prohibit any fees during the loss mitigation review cycle beyond the amount scheduled or calculated as if the borrower made all contractual payments on time. And this goes beyond just late fees. This would restrict the accrual of interest, foreclosure related fees, and that kind of thing. And the CPB thinks that the fee restrictions will incentivize servicers to evaluate the borrower and find an option to assist them as soon as possible. In addition, the Bureau proposes to amend the early intervention requirements in several ways. Currently, servicers are required to send borrowers early intervention notices that give a general overview of the loss mitigation options that may be available to them, and they're required to send this letter no later than the 45th day of the borrower's delinquency. So, among other changes, the Bureau proposes to require servicers to include additional content in the early intervention notices, including more specific information about the loss mitigation options that may be available to the borrower, the name of the investor currently holding the borrower's mortgage, and a website address in which the borrower could access the list of all loss mitigation options that may be available to them, among other things. The Bureau also proposes to amend the notice of error provisions to state that the provisions cover a servicer's failure to make an accurate loss mitigation determination. So, this means essentially that if the borrower submits a qualified written request stating that they were improperly denied for a loss mitigation option, the servicer would be required to follow the Regulation X requirements, the notice requirements, sending that acknowledgement notice within 5 days, fully resolving the complaint within 30 days or 45 days. The Bureau also proposes to make certain changes to the requirements related to appeals of loss mitigation denials. And they're proposing to amend the requirements related to loss mitigation decisioning notices. Under the proposed rule, kind of, similar to the theme we saw with early intervention, they want servicers to provide more information. So, servicers would be required to provide borrowers with additional information in connection with their loss mitigation determinations, including the specific reasons for the determination and any quote key inputs that served as the basis for the determination, such as maybe the borrower's income. And the notices would be required to include a telephone number and a website to access the list of all loss mitigation options that may be available for the investor. And the Bureau explained that the servicer is responsible for making sure the website is accessible and contains accurate and complete information. And the Bureau is also proposing to amend the Regulation X requirements related to record retention. So the requirement is to retain records that document actions taken with respect to the borrower's mortgage loan. And they want to clarify that that includes retaining records evidencing compliance with Regulation X. Next, the proposal requests comments related to furnishing information for borrowers undergoing a loss mitigation review. The CFPB indicated that through its market monitoring activities, it's aware of some instances in which servicers may be furnishing information about borrowers undergoing loss mitigation review that raises questions about accuracy and consistency. They mentioned that some servicers furnish information indicating that a consumer is delinquent in making a payment, even after the borrower has accepted a loss mitigation option and is performing according to the terms of that loss mitigation option. And then the Bureau also mentioned that some servicers are not always reporting a natural disaster code when the borrower is impacted by a natural disaster. And I think most of this stems from the fact that there's some flexibility in how servicers furnish. The legal obligation at a high level is to furnish accurately. And then most servicers work to furnish in the Metro 2 format, kind of the industry standard format. And while Metro 2 includes a lot of very detailed data points and requirements, there are some codes, like the codes indicating the consumer is impacted by a natural disaster, that's optional. It's not required by Metro 2. And in cases in which there are particular circumstances of the loan that are not expressly addressed by the Metro 2 guide, servicers make judgment calls about how to most accurately report the loan. And then the Bureau also listed a few other issues in the proposal on which they're seeking comment, including zombie mortgages and state law issues. And then one of the most significant aspects of the proposed rule is the portion addressing translating documents and providing information to consumers in languages other than English. And my colleague Tori is going to cover those requirements in more detail. And for now, I'll turn it over to Krista Cooley to share her observations about the proposed rule.
Thanks, Krista. So, as you can all see from Krista's excellent and thorough summary, the CFPB has proposed significant changes to the process for handling delinquent borrowers under Regulation X, rather than making targeted edits to portions of the existing regulation. Now, that obviously gives industry participants much to think about, and not surprisingly, raises questions about how the proposed changes will work. First, as Krista noted, the proposed regulations would move away from the complete and incomplete application process to a completely new construct of a loss mitigation review cycle, which she defined and which the proposed rule would define. Now, that, as Krista mentioned, could create more flexibility for mortgage servicers to be able to evaluate borrowers for loss mitigation alternatives available by the mortgage loan's investor, and could also create a more efficient process to provide loss mitigation alternatives more efficiently. For example, being able to do it simultaneously sequentially, and not waiting, as Krista said, to have all of the documents in place in order to look at all available options at once. The proposal, however, would relax the requirements to enter a loss mitigation review cycle and change the procedural safeguards that would need to be met before initiating, or now, under the proposed rule, advancing a foreclosure, which, depending on particular circumstances, could actually increase the time frame of the loss mitigation review cycle, particularly given the ability to review the borrowers, like I said, sequentially for loss mitigation options, and the requirement to inform borrowers of the determination in that determination notice of options that the borrower had previously not accepted. So there creates a little bit of an actual cycle, as the name suggests, of being reviewed and going through the appeals process for various options. And that is not 100% clear in terms of how those pieces would work together based on the currently proposed rule. Krista also noted that one of the proposed safeguards would be met if the borrower has been evaluated for all available loss mitigation options and no options remain after the appeal process has been exhausted. The proposed regulatory language, however, does not define or clarify when an available loss mitigation option no longer remains. There are many investor requirements that presently provide alternatives to foreclosure, including alternate disposition of the property options throughout the foreclosure process. Moreover, while the preamble to the proposed regulation states that a loss mitigation option would not be available if the borrower affirmatively opts out of the option, if the borrower rejects an option that's offered by the servicer, or if the servicer determines that the borrower is not eligible for an option, that language is not set forth in either the proposed regulatory language changes or the commentary. So it's also unclear how that requirement in the determination notice to inform the borrower about prior options that were not accepted would impact this new framework. The proposal includes guidance on how servicers should handle duplicative loss mitigation requests by proposing language that would amend the rule to require servicers to comply with the revised Section 1024.41 for loss mitigation assistance during that same loss mitigation review cycle, unless one of the procedural safeguards has been met. But the rule does not address whether or how that Section 1024.41 requirements might apply to any subsequent request for loss mitigation assistance once one of the procedural safeguards has been reached if the borrower again requests assistance. So one of the other things that Krista noted is that the proposed regulatory changes would require the servicer to provide the borrower with a determination notice that would include a significant amount of information about the loss mitigation evaluation and determination that is not presently required by Regulation X. Two of those requirements, which Krista mentioned, are key borrower provided and key non-borrower provided inputs that servicers used as a basis for making the loss mitigation determination. Those terms are not defined in the proposed regulation. So, as Krista noted, the preamble includes some examples, but it does not provide a comprehensive list of what those types of borrower or non-borrower provided information would be. The rule, as proposed, also does not address how to identify such inputs for servicers who utilize automated loss mitigation evaluation tools to implement certain investor waterfalls, where what was the determinative factor may not be as clear, particularly for some of the extremely complex options like the FHA payment supplement partial claim and the VA VASP program that are being developed right now. So, unfortunately, the proposal also does not offer a template for the determination letter or the other notice requirements set out in the early intervention section of the proposed rule. The early intervention section also What it does do is propose changes that are aimed at minimizing potential borrower confusion for those borrowers in a forbearance so that they don't receive notices regarding other loss mitigation options during the forbearance. But the proposed changes for both the early intervention notice and the notice to borrowers who are exiting forbearance require the inclusion of, as Krista noted, the name of the owner or assignee of the borrower's loan, as well as contact information so the borrower can access information regarding loss mitigation options available from the owner. This has the potential to cause confusion for the borrower because often loss mitigation options are dictated by the investor requirements to which the loan is subject rather than the owner of the loan's requirements. So it isn't clear how, in those instances, a servicer should disclose investor requirements that are going to really dictate the loss mitigation evaluation and decision versus the owner of the loan, which may not be as relevant a piece of information as the investor requirements. These are but a few of the questions and considerations that have arisen as we have begun to really deeply review the proposal's extensive suggested regulatory amendments. We expect this list will continue to grow as industry participants continue to digest the proposed rule and consider how its implementation would actually operate. So, right now, I'm going to turn it over to Tori, given our short time here, to discuss the CFPB's proposed provisions addressing communications with borrowers in languages other than English.
Thanks, Krista. As Krista kind of alluded to, in the proposed rule, the CFPB is proposing certain language access requirements that would seek to provide borrowers with limited English proficiency with access to mortgage servicing communications in languages other than English. And these requirements would be for both written and oral communications, depending on the particular circumstances. And just by way of background, the CFPB has been focused on limited English proficiency consumers and doing business with limited English proficiency consumers and issues related to language access for a number of years now, and has questions already in its mortgage servicing exam manual about the provision of services to these LEP consumers. The CFPB regularly asks for this information as part of its mortgage servicing exams, and there are currently optional servicing disclosures that can be provided in languages other than English, but again, this has all to date been optional. If the proposed rule is finalized, this would be the first time that mortgage servicers would actually be required to provide servicing communications in a language other than English. Now, the proposal outlines 5 key areas where mortgage servicing communications with delinquent borrowers would be required in languages other than English. Notably, the CFPB is not including proposed regulation text for these requirements, and they're pointing out that there may be multiple ways to structure the requirements depending on the aspects of the proposed rule that are ultimately finalized. Ultimately, this raises concerns about whether or not this is appropriate notice and comment rulemaking and whether or not industry participants will be given an opportunity to comment on the proposed language before it's finalized in a way that's appropriate and provides advance notice to the industry. Nevertheless, again, there are these 5 key areas where mortgage servicing communications would be required. The first is that a mortgage servicer would be required to provide all borrowers with certain written communications in Spanish as well as in English. The CFPB is proposing to require that servicers accurately translate certain communications into Spanish and provide those versions along with the English versions to all borrowers. Again, all borrowers, regardless of preferred language preference, regardless of the language the borrower actually speaks, these would need to be provided in both English and Spanish. And these 3 sets of communications are the required written early intervention notices, the written notices for borrowers whose forbearances will end soon, and the written notices regarding loss mitigation required under Section 1024.41 that Krista talked about earlier. Now, there are a number of potential obstacles to implementing this requirement. One would be obviously ensuring the accuracy of the translated documents, particularly when there is variation in the documents, like the custom loss mitigation disclosures that my colleagues were describing a few minutes ago. There's also the risk that technical mortgage and legal terms may not have a direct translation or may have more than one acceptable translation. So what does this mean for servicers who don't have the ability to perform translations in-house and who must rely on third parties and outsource this service? What does this mean for quality control of translated documents by these servicers? I think those are all kind of unanswered questions and potential obstacles to implementation. The second category of language disclosures, in addition to the automatic translation of the notices I mentioned a minute ago into Spanish, the CFPB is also proposing that servicers would be required to translate those 3 notice categories into 5 additional languages, but those would be upon borrower request. Now, that last part is important, upon borrower request. Unlike the Spanish translations that I was mentioning a minute ago that must be provided to all borrowers regardless of any expressed or inferred language preference or request, this next set of translations for certain oral communications and written communications would be required only upon the request of the borrower. One of the key challenges is what it would mean for a borrower to actually make a request like this, particularly when you're dealing with borrowers who do have limited English proficiency, and whether or not there's an ability to make that request in a way that a servicer might understand. A little bit more on that later. So generally, the proposed rule would allow the servicer some discretion to select those 5 languages that I mentioned for compliance, so long as collectively the languages chosen address the needs of at least a significant majority of the servicer's non-Spanish speaking borrowers with limited English proficiency. Notwithstanding this servicer discretion that's called out in the rule, the servicer would be required to select languages that collectively address the needs of at least a significant majority of the non-Spanish speaking borrowers with limited English proficiency. The CFPB also notes in the proposed language that the servicers may need to reevaluate the language decisions periodically. So one of the obvious potential compliance challenges is how often this reevaluation would be required to occur. So for example, is it sufficient to evaluate language preference every 5 years, or does this need to be done on an annual basis? Or does it need to be even more frequently than that, perhaps after the acquisition of a large servicing portfolio? These are all open questions. Also, it's not described in the rule how the servicer would be expected to make this language assessment. Now, you may recall that there is a language preference question that is now required under Fannie Freddie loans, but obviously that's a newer requirement, and so there may not be language preference available on a loan-by-loan basis. So how are servicers expected to make this assessment and determine whether or not these 5 languages cover a majority of the non-Spanish speaking borrowers with limited English proficiency? There's also potentially a question about, is there some sort of minimum threshold of borrowers that would be required to speak one of the languages chosen by the servicer? For example, if less than 0.5% of your borrowers speak this language and it's the 5th language after English and Spanish, are you still required to make these translation services available? Third, in addition to the translation of certain written communications into Spanish and the 5 other languages, the proposed rule would also require servicers to provide interpretation services to specific oral communications upon the request of a borrower. So oral communications under the proposed rule would include the live contact requirements, as well as oral communications that are made in compliance with the servicer's continuity of contact requirements under Section 1024.40. The proposed rule would require servicers, again, upon the request of the borrower, to make available and establish a connection, for example, making a telephone call in real time, with interpretation services either before or within a reasonable time of establishing a connection with the borrowers during the specified oral communications. And again, this is in the 5 servicer selected languages, in addition to English and Spanish. This means that the servicer would need to have employees that spoke all of these languages, or to use a language line service to make the telephone connection in real time. And the rule makes clear that the CFPB is expecting that the servicer is the party responsible for coordinating the interpretation services, and the onus should not be on the borrower in order to access these services. Again, the servicer would be required to ensure that the translations and the interpretation services are accurate, and the failure to provide accurate translations or interpretations would result in the violation of the underlying requirement. So ensuring the accuracy of oral communications by a third party in a foreign language is one of the obvious potential challenges and burdens for this aspect of the proposed rule. The Bureau is also seeking comment on whether it should make other oral communications subject to this language requirement. Again, right now, the proposal is only the live contact requirements and oral communications related to the servicer's continuity of contact requirements. The fourth category of language access requirements relates to the requirement that the servicers provide 5 brief statements in those 5 servicer selected languages that are accurately translated in the English version of the written communications for which the translations will be made available. And the brief statements in those 5 servicer chosen languages would be required to identify how the borrower can request translation or interpretation services. The CFPB, the proposed language, does not provide any structure or guidance around the borrower request for those translation or interpretation services, how that request must be made. And the CFPB also is not proposing any model disclosures for any language for that brief statement that would be required in those written notices. The last and arguably the most controversial category of proposed language access requirements related to translation and interpretation services is based on in-language pre-origination marketing. So if a borrower received marketing for their mortgage loan before origination in a language other than English, and the servicer knew or should have known of that marketing, the proposed rule would require that the servicer make translations or interpretations for that language available, even if it's not one of the 5 languages selected by the servicer for the requirements that I just discussed. So the example of this provided in the proposed rule is that if a servicer knew or should have known that a mortgage it services was marketed to a borrower in Navajo, then under the proposed rule, it would be required to provide accurate Navajo translations of the required written early intervention notices, the written notices for the borrower whose forbearances will end soon, and the written notices regarding loss mitigation that are required. The servicer would be required to comply with the translation and interpretation service requirements, even if it's not a language selected by the servicer. This requirement is problematic for a number of reasons. First, what does it mean that a servicer knew or should have known about marketing communications, particularly if the servicer is not the same entity that originated the mortgage loan? As listeners may know, a loan is often transferred multiple times throughout the lifetime of a mortgage loan. It could be transferred 5, 6, or 7 times. And that can really be problematic from an information transfer perspective. And this knew or should have known standard is not further defined in the rule. So taking all of these requirements together, obviously there are a lot of new potential requirements and potential compliance burdens, obstacles, challenges that servicers may have as a result of the proposed rule. The language access requirements in particular would likely pose significant compliance challenges. As described above or during the earlier portions of the podcast, the CFPB is currently proposing to limit these language access requirements to delinquency-related communications. However, the Bureau has stated that it may also consider additional language access and translation requirements in future rulemakings. The CFPB is also seeking comments on a number of questions related to the 5 language access areas I just discussed. So how have you heard, based on our comments throughout this, there is a lot to digest in the proposed rule, and we expect that there will be numerous comments submitted by the industry given the potential wide-reaching ramifications of the proposed rule. So with that, I will turn it back over to Krista for some closing remarks.
Thanks, Tori. So one last item I will mention are the proposed effective dates. The CFPB in the proposed rule suggested that the provisions regarding loss mitigation changes to the regulations would be effective 12 months after publication of any final rule, and that the limited English proficiency requirements that Tori just summarized would be effective 18 months after publication of a final rule. And along with every other piece of this that we have covered, and even the pieces that we did not have a chance to cover, or challenges that we did not have a chance to discuss, this CFPB has requested, and mortgage industry participants and other interested parties are encouraged to comment. And as Tori just said, there is a lot here to comment on once it is fully digested. And those comments are currently due by September 9th. So we want to thank our audience for listening. If you have any questions about today's podcast or anything else related to global financial markets, please email us at gfm@mayorbrown.com. Thanks so much for listening.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.